Hi, welcome everybody. It's John Pokaroba. It's April 9th is when I'm recording this, and we're going to do our general market update. So just a reminder, this presentation is by Rain King LLC. I'm an amateur investor not associated with IBD or MarketSmith, but I've been trading for over 20 years. And my typical disclaimer. So in today's market video, we're going to talk about the big picture very quickly in the economic cycle, the current market environment, particularly with growth stocks, and we're going to evaluate this first pullback after we had the thrust off the lows. So the big picture, really quickly, this is just the NASDAQ monthly chart. As a reminder, there's still some very long-term trend lines in place that could allow the NASDAQ composite to come back to the 11,000 area, which would be almost a 30% decline, and still be in the super cycle that started in 2009. This chart is really about the economic cycle, and I think I've used it before, but the one on the right basically shows, when the economy is expanding, peaking, recession, and recovery. In the current economic cycle, we're getting late in the cycle, where the economy is at late stages. And we talked about before about financials, energy stocks, material stocks tend to perform well late in the cycle. This diagram to the left is just showing the blue bell curve shows how the stock market cycle precedes and discounts the economic cycle, which can peak later than the actual stock market. You'll notice that we're somewhere in this range here. I've shown with the red arrow. And again, groups like 9/11, 1 and 3, energy and precious metals, and some of the healthcare stocks start to outperform late in the cycle. So that's the big picture context. So let's get into the actual current market environment. On the left is the NASDAQ composite, the daily chart. And I just wanted to highlight a couple things for context. We had this major thrust off the lows, almost a 17% move a couple weeks ago. We had a follow-through day in there, which I've marked in green. And what's happened since we ran into the lid of the 200-day moving average, and what's this pullback look like, and what is it? Is this a healthy pullback or a non-healthy pullback? At the moment, we're going to just talk about, we have broken the 20-day moving average in magenta, and we've broken the 50-day, which is in red. I've marked the low of the follow-through day here. If we break below that and show more weakness, that would be a bad sign. And it would also probably indicate the odds would favor that we're going to come down in the vicinity of the lows. And who knows, we may break the lows, which I've marked here on the chart. Now on the right, you'll see the S&P 500. The S&P is certainly the stronger index of the two. You'll notice that its push off the lows got it above the 200-day and above the 50-day. Its pullback has been more constructive in the sense that it's getting support at the 200-day and the 20-day is still holding. That's a good sign for the S&P. My fault. So I wanted to talk about some of these beaten down sectors. When you look at this chart, you can see that some of the beaten down sectors over the last couple of weeks had turned up. That's the semis, the software, some of the cybersecurity and solar stocks. It looks good, but these sectors are so far off their highs that in a moment I'm going to show the context on a bigger time frame. There are many good companies in these sectors, but at the moment, they're not good stocks. They're 40, 50, 60, 70% off their highs. So this is actually the exact same chart, except for I've added the leading sectors, which is the metals, the energy stocks, and the oil stocks. And you can just see by comparison that the beaten down software and semi stocks, they're really laggards. They're not leading the market. And the market is really being led by late cyclical stocks. So the perspective is important. Talk a little bit about the yield curve. It's on everybody's headline right now, and everybody seems to be very sensitive to it. Ryan Dietrich put out a tweet last week, which I think is really worthwhile looking at. He looked at the 210 inversion, and the last 4 times that the 210 inversion occurred on the yield curve, you'll notice that he said the S&P has outperformed. It's actually been up almost 29% before the market peaked. And that ultimate peak was actually approximately 17 months later. So these inversions in yield curves, they are warning signs, but they're not cataclysmic. You'll notice some pretty good performance the last 4 times the 210 inverted. So it's important to know that, while every recession has been preceded by a yield curve inversion, every yield curve inversion does not lead to a recession. And the time waiting for this, quote, recession that may or may not happen, which could potentially be, 17 months later, they can be profitable if you're positioned in the right sectors and the right names. This is a chart by Ned David Research, and I think it's a really good one to take a look at here. What this is trying to show is this dotted line is representing the first rate hike of the Fed, and it looks at the performance of the S&P 500 during a couple of different scenarios. One is if the Fed is using a slow rate hike tightening cycle, you'll see the S&P in black here. This is how it performed. It has an upward bias when there's a slow controlled tightening cycle. If there's no tightening going on, you can see in green, it's even a better performance. Now, the worthy note line to look at here is the orange line. The orange line represents fast tightening cycles by the Fed. And over the last week or two, we've seen the Fed say in a multiple of ways that they are going to accelerate tightening to deal with inflation, and they're going to accelerate the balance sheet reduction. So you'll notice that the orange line is sideways to down, and that's just important to understand. That's the context that we're in at the moment. The last time we were kind of in a similar condition to this was back in the 1970s. You'll notice there is a situation where this first column is inflation year over year, and the second column is the Fed funds rate. In 71, 72, there was, moderate inflation at 3% plus or minus. And you'll notice that in 73, 74, inflation accelerated rapidly into the 9 to 12% range. And the Fed had to hike rates fairly significantly to deal with that issue. So it's important to just understand the context that this is kind of very similar to the context we have with high inflation. So if you look back at this period between 73 and 74, some of you may remember, some of you don't remember, but if you don't, go look back at this period. This was a devastating 1973-74 bear market. It was a very slow grind down for almost 2 full years from the peak to the trough. And it was almost a 50% decline. It was marked by 3 very distinct legs down, which I've marked on the chart. It did have some bear market rallies within this overall bear market. It's probably noteworthy. This is, again, a period of time with high inflation and slow economic growth. Commodities, though, did very well during this period. And I know Bill O'Neill did trade some of the oil stocks like Dome Petroleum and Houston Oil and some others. So again, just trying to understand some of the similar periods in market history. So I want to look at the pullback in relation to growth stocks and how do we evaluate that pullback. So I pulled out the slide. This is the exact slide that I had in my March 20th video update. And I've highlighted the box. And I mentioned at that March 20th update that we would learn much more about this rally in the NASDAQ if it was a tradable rally within a bear market or it was a new bull market. So we want to evaluate that pullback. And this is exactly what I had said in that video, the things I would want to look for to determine one or the other. So let's really do a report card. Let's go through the market and take a look at how does the NASDAQ look. So here's our criteria for evaluating the pullback. The first one that I mentioned I would be looking at is looking for change. I wanted to see the index hold key moving averages like the 20-day moving average and the 50-day moving average. So what does it look like? Well, we gapped down through the 20-day moving average, and we're actually closing below the 50-day moving average on Friday. So in terms of a report card, this gets an F. The second piece to evaluate, I said, was look for lower volatility, smaller controlled price spreads. Now, this is a little bit mixed. I think you can look closely and see that these price spreads are definitely a little better than what we see on the left side of the chart, which was the immediate sell-off. But what I don't like about these price spreads is what I call pistons. You know, you have one day we finish up strong and at the peak, and the very next day we close at the complete bottom of the range. This piston action is not great. But again, overall, I think this gets a grade of a C. It's a little better, but it's certainly not what we'd like to see ideally. Next is breakouts. So we look at breakouts, we said we want to see if they're following through or if they're failing. And, you know, a couple of weeks ago, the semiconductors looked very promising. They were breaking out on good volume, but unfortunately, they've all have been failing. And I've listed, you know, some of the semis, some of the leisure stocks, et cetera. We're seeing failed breakouts in the growth sector all over the place. So this is clearly not a good grade. I give this an F. It's not what we want to see. The next criteria I would use, as I said, I did not want to see new lows expand. So this is a chart of the breadth, one way to look at breadth, which is net new highs minus new lows. And on the top is the NASDAQ composite. You can see on the rally attempt, the new lows really started to dry up. This was very, very promising. But in this pullback, what we said we learn more is the new lows are expanding again. That's not a good sign. Again, on the New York Stock Exchange, we actually achieved net new highs in terms of the rally attempt, which was really promising. Again, even new lows, again, is expanding on the pullback, not to an excessive level, but more than I would like to see on a pullback. Again, we mentioned the S&P is probably the stronger of the two. So I don't give this a good grade. It's not what I wanted to see. So I think it's an F. And the last thing I mentioned to look for was to look at 3 key institutional growth stocks. And we wanted to look at Apple, Tesla, and NVIDIA. So Apple, I had marked the 180 level as a really important level because it represented about a 3 trillion evaluation in Apple. And we want to understand if institutional growth investors see this company being worth more than 3 trillion, and we actually break out and they see a higher valuation. Even though we had this very strong run up, you can see it was rejected almost right at the 180 level and pulled back. Now, it hasn't broken down completely. It's still above a upward sloping 50-day moving average, but it's been rejected. I'd probably give Apple about a C. The next is Tesla, and I marked the 1,000 level as a 1 trillion valuation, similar concept to Apple. What do the institutions think? Apple's the strongest of the big tech leaders. It's backed off from a very strong run up. It's still above the 20-day moving average. So this is good. Hopefully it actually can hold there. So I give Tesla a B, and NVIDIA was the third. I marked the 300 level. It's a round number psychologically, as well as way over on the left side of the chart was one of the highest volumes in NVIDIA's chart in the last 6 months. The run up and the breakouts looked, you know, pretty promising again, but it's been rejected. And in NVIDIA's case, it's broken down all the way through the 50 and through the 200-day moving average. So NVIDIA gets an F. So, you know, what do we see in evaluating the pullback? We just went over the report card. And again, this is a very poor performance relative to growth stocks on this pullback. We didn't see the type of things that we wanted to see to give us an indication that this was really an aggressively new bull market. We have to recognize we're in an aggressive rising rate environment, and that is not good generally for growth stocks to attract money. They have a very difficult time competing with the rising 10-year yield. Clearly, inflation is a major problem and getting sticky, as the Federal Reserve has made it clear they're going to attack inflation first, and the economy will be essentially second. So my opinion, and this is just my thoughts from what I see on the charts and the action, is the odds are favoring we are going to probably come down and test somewhere in the vicinity of the lows. You know, we may be surprised. Maybe the lows will hold and the market regains its footing, and this follow-through day would still be alive. Follow-through day number 2 is still alive until we break the actual lows, and that's when we would officially say the rally is dead. So if we do undercut those lows, we have to recognize that a deeper, longer bear market is probably underway, and it started back in November of 2021. So that being said, I want to come back up to the economic cycle and some of the late cycle sectors that still are performing well. So on this chart, I'm showing some of the late cycle energy, oil, metals, and fertilizers. And they're shown basically in these rectangular boxes here. And then we're going to talk a little bit about some of the defensive ETFs. So the late cycle sectors have actually been consolidating over the last 2 to 3 weeks. They've been digesting a very strong run up in the last couple of months. And we have to recognize that eventually these sectors of the market will roll over and top. But this sideways consolidation looks like there's more room to run if these stocks can break out and make another leg higher. So we want to keep our sell signals relative to these types of stocks on our radar. We want to look if we see climax runs, upper channel line breaks, breaks of the 10-week moving average on volume. So the late cycle sector still might run for a while, just like in the 73, 79 period. We don't know, but they still could have months of upside. So you'll notice that the defensive sectors, and I've shown consumer staples, healthcare, and utilities, they have been rising rapidly ever since the Fed, and I've marked right here on the chart, the Fed has basically started to raise the rates, and they said they might accelerate with using half-point rate hikes, and they've talked about how they're going to accelerate the balance sheet reduction. Clearly, these three turning up is signaling a discounting of the economic slowdown later in this year, probably starting in 6 months out. So it's the combination of the two that even is further evidence that we're later in this bull cycle. So this is just the consumer staples divided by the S&P 500. And you can just note that this downward trend line was broken as consumer staples have started to outperform. They pulled back, and we got a higher low in place, and we've actually come back above that. So, the consumer staples have established themselves as being in an uptrend. And this is just a look at the XLE, which is the S&P Energy Sector ETF. And you'll notice that even though we've had a very nice move in 2021 and even steeper in 2022, if you look at a longer term chart, we're at the levels of pretty much the 2018 highs in the XLE. So in a sense, we could be looking at a breakout. This could be a 5-year breakout in the energy sector, which may have much more room on the upside. So it's just a change in perspective from the short term to a little longer term on these energy, oil, and metal sector. So there is a bull market going on in commodities, as I just mentioned, but we want to make sure we're in touch with where they are. Now, institutional activity is still very strong in these sectors. We are seeing accumulation distribution ratings that are very strong. I've mentioned here's 4 oil stocks, and you can see A+, B+, B-. These stocks are still under accumulation by institutions. The next 3 are coal stocks, and you can see again, strong accumulation is still underway in this sector. And the last 4 are all agricultural fertilizer stocks, again, showing strong A and B accumulation distribution ratings. So we have to recognize the institutions are still putting money into the sectors. So that's all I have time for now. I appreciate everybody spending a little bit of time with me. Again, my Twitter handle, hopefully you'll join me there, and subscribe to my YouTube channel and hit the bell to get notifications of of new videos. Thanks, and I'll see everybody again soon.